market? The market is a place of contact between buyers and sellers. Now, then there's always going to be what? Interaction. And when we talk about interaction, it's simply talking about the negotiation that happens in the market. I want to buy. Do you want to sell? I want to sell too. So, but we have to reach an agreement about price. So one of the functions of money is a unit of account. That means with the help of money, we are able to give, or we are able to name, or we are able to give a price to every product that needs to be sold. So money has solved the problem about finding issues regarding measurement of or unit of account. So money has solved that. So that means for every product available, for every commodity, there's always going to be a price for it. So that is the price we have to agree on. So the market forces of demand and supply will definitely have to reach an agreement. So that's why when you get to the market, before you are able to buy, you ask about the price. Or probably there's a price tag. So the price tag is the price they want to sell. And when you check throughout the markets, in that same market, the cost of production are always the same. So going towards different shops that have the same products or that have homogeneous products, you're still going to see almost the same price. Because that is the market price, based on the cost of production. Are you guys with me? Yes. Great. So that's what the market is. There's always going to be interaction between demand and supply. So I'm going to read now. The interaction of demand and supply. In any marketplace, there's always going to be the market price. This is called the equilibrium price. So there's always going to be equilibrium price. Here, this is the equilibrium price. The price of agreement between quantity demanded and quantity supplied. I think you understand equilibrium price.
Yes.
Great. So with this equilibrium price, it is assumed by economists that as soon as there's an agreed price, the market will clear. So we call the equilibrium price the market clearing price. Why? It is assumed that all products bought to the market will be sold. Because the price is agreement between demand and supply. Get the point here. The equilibrium price is also the market clearing price because it is assumed that as soon as the price has reached an agreement with consumers and suppliers, all the goods that are in the market will be sold because consumers will be willing to buy. Do you understand market clearing price here? It's a market clearing price of $5, and we have 1,000 goods there. So it is assumed that because the price is equilibrium price, the 1,000 goods or the 1,000 units of goods that are in the market will be sold. No goods will be left unbought. That is why it's a market clearing price. Do we understand market clearing price? Please sit down properly. Sit upright. Do we understand market clearing price? Do we understand, please? Great. So that's about that. Then we go to the interaction. I already explained anyway. There's always interaction between demand and supply, which is the agreement between demand and supply. So we move on to equilibrium price. We call it equilibrium price. So this is what agreement is all about. So there's equilibrium point, there's equilibrium price, and there's equilibrium quantity. What is equilibrium point? The point of agreement between demand and supply. Stop that already, please. The point of agreement between demand and supply is called equilibrium point. This is the point. Do you understand equilibrium point? Then we have equilibrium quantity, which is the quantity of agreement between quantity demanded and quantity supplied. Do you understand equilibrium quantity? Do we understand, please?
Yes.
Great. Then we have the equilibrium price, which is the price of agreement between demand and supply. Any question about equilibrium? We move on. The total revenue, because there's always price and quantity sold in the market. So total revenue is the amount of receipts, the value of receipts based on what you sell as a business. So we have, like I said earlier, we have 1,000 units of goods. The price is $5. So our total revenue will be $5 multiplied by 1,000 units, which is $5,000. Do we understand? So $5, 1,000 units. 5 multiplied by 1,000, P multiplied by Q gives us our total revenue. Is it clear? Any question about total revenue? Total revenue is price multiplied by the quantity sold. P multiplied by Q. Are we together? We move on. Changes in demand. So for changes in demand, it is not the same as price. There's price and demand. Now we're talking about changes in demand. Changes in demand could be as a result of an increase in demand or a reduction in demand. And as soon as this happens, firms will have to react because it's a market forces. So firms are observant. They want to know what happens in the market so that they can make their own decisions. So every day that passes by, firms are always there. Their representatives are always out there. Is there a question? Their representatives are always there to know the events in the market, and that makes them to decide on what price to sell. So now we're going to take an example here. Let's assume the price, the market, the price, the equilibrium price is at Q. Equilibrium price, equilibrium quantity is at Q. As soon as the quantity demanded increases of that product, an increase in the quantity demanded will bring about a rightward shift in the quantity demanded, in the demand curve. An increase in demand will represent a rightward shift in the demand curve. The demand curve will shift rightward from D to D1. That is the first situation. The demand curve will shift rightward from what? D to D1. As soon as this happens, it is expected of suppliers to react based on the high demand for their goods and services. Suppliers become more advantaged at this point because you want more of our product. Yes or no?
Yes.
When you want more of our product, it means our product is the latest, our product is trending. That is a fact. So what do? We have to react. Reacting means we use the opportunity, we seize the opportunity to make more revenue as well as profit. So what happens to the price? The price increases from P to P1. Do you get the situation here? The first situation is there's a change in the quantity demanded. There's an increase in the quantity demanded, which has bring about a shift to the right of the demand curve from D to D1. As a result of that, the price of the product will increase from P to P1. Do we get it? Because the quantity has increased from Q to Q1 based on the fact that there's an increase in the demand. Do you understand the first situation here? So the first situation is telling us that as soon as are you here?
Yeah.
As soon as the quantity demanded of a product increases, firms are expected to increase their price. That's clear, right? Any question about that? So that is the first situation. Now looking back here, based on the law of supply, the higher the price, the higher the quantity supplied. Yes or no? Great. Because the price of a product up here has increased, based on the quantity demanded increasing, firms will do more of supply. They will increase their supply from S to what? S1. Do we get it or not?
Yes.
Firms will increase their supply. We say the higher the price, the higher the quantity supplied. Isn't it? The law of supply, not demand. The higher the price, the higher the quantity supplied. The lower the price, the lower the quantity supplied. That is the law of supply. Right or not?
Yes.
Great. Because of this situation here, that consumers are willing to buy more, firms are able to supply more. They increase the price from P to P1. From P to P1. That brings about an incentive, a motivation for them to increase their supply. So the supply curve will shift rightward as a result of that, from S to S1. Do we understand? Do we understand? So now, as soon as supply increases from S to S1, consumers understand they have to react. What do? Because there's excess now in the market. Supply is more in the market. So as soon as supply increases in the market, the price of the product what? Falls. Do you get what I'm saying here? The supply will fall. And as soon as the supply falls, the price will fall from P to P1. Do we get the situation or not? I'm going to quickly summarize the situation. The first thing that happens is that there's a change in the quantity demanded, which has bring about a rightward shift in the demand curve from D to D1. As soon as there's a rightward shift in the demand curve from D to D1, firms are expected to increase their price from P to P1. Done. Then the market will be at equilibrium. Because at every point in time, the market must be at equilibrium. There must never be equilibrium. Because if there's equilibrium, it means the market is not going to clear. So as soon as price increases, consumers want more. Consumer wants more, price has increased. Suppliers will supply more because they want to make more profit, isn't it? In the course of supplying more, the market will go to a disequilibrium because consumers would have had excess. So to reduce the excess, because excess represents disequilibrium, you had better be here. To reduce the excess, firms would need to reduce their price because consumers are conscious about price. They only want to buy more when the price is favorable. So for the price to be favorable, it has to come from P1 to P2. At that point in time, supply is more, price is less. The consumers will buy more. The market will come back to equilibrium. Do we understand changes in demand now? So there's always going to be changes in demand, either increase or decrease. But as soon as it increases, price is expected to increase. If demand reduces, price is expected to fall. Because if demand reduces, it means consumers do not want to buy. Firms want to sell. And what can they do? They have to reduce the price to attract customers to buy. Any question about changes in demand? Clear, right? Thank you. That's all.